Welcome back to Big Richard's Newscast. I'm John.
And I'm Big Richard.
Japan's growth, inflation, interest rates has all been relatively steady over the past decades. However, recently it has been continuously declining and reaching the lowest value in 34 years of 160 yen to 1 US dollar. As of now, Japan is a very import-dependent country, with importing more than 90% of its energy and 60% of its food.
Exactly. The Japanese exchange rate to the US dollar has been depreciating rapidly, which is very unusual for Japan since they have been pretty stagnant for over the couple decades. However, Japan has recently been on a steady decline for the last 4 years. The Japanese government intervened and used foreign currency reserves to purchase large amounts of yen. On April 28, Japan reached a 34-year minimum of 160 yen to 1 US dollar, surpassing the threshold of 155 yen to 1 US dollar. Therefore, on April 29, Japan tried to bring the value higher. However, it only lasted for a few hours until it bounced back up again. This also occurred on May 2nd. The Japanese government spent a total of $35 billion on these two buy-ins that only lasted a few hours. This occurs due to a fundamental issue located within Japan that has not been solved. Since the $35 billion are acting as an artificial indicator to display that the Japanese yen is being used by foreign markets, this is not true due to consumers are not utilizing yen due to its weak value. Thus, the forex appreciates the value of the yen to the US dollar, decreasing the overall value. This process of the Japanese government buying the yen to increase its value and a forex exchange decreasing the value is an endless cycle until Japan does not have enough foreign reserves to continue. Now we had the opportunity to interview Stephen Lee, an avid investor and a portfolio manager for a family office of over 25 years of experience, plus corporate development experience with 500 firms. He earned a Bachelor of Applied Science degree from Queen's University and a Master's of Business Administration degree from York University. He's a chartered financial analyst and a professional engineer in Ontario, Canada. Good afternoon, Mr. Lee. Thank you for being a guest here at our newscast today. Today, we would like to discuss the depreciation of Japanese yen against major currencies, especially the US dollar, in the past few years, from around 110 yen to 1 US dollar over to 150 yen US dollar in a whopping 40% decline. We would like to ask you on what are your thoughts on the latest trend of the Japanese yen?
So talking about the Japanese yen is a hot topic these days. First of all, and based on my understanding, the Bank of Japan, the BOJ, will probably intervene when depreciation of the yen becomes unsustainable. So what I meant by unsustainable depreciation is when it actually impacts the growth of the Japan's GDP, I would say. And as you know, when yen becomes weaker, the import price will turn higher, and the one biggest items that Japan imports is the energy, right? Like oil and gas.
Yeah.
So if energy price hikes becomes out of hand, consumers and business will definitely suffer, and leading to less corporate profits and less consumer discretionary spending. So which eventually impacts GDP. So that's I would foresee in the short run.
Do you think Bank of Japan's BOJ would intervene by tightening monetary policy to stop yen's depreciation? And do you think it's a good strategy in an open market environment?
So I kind of answered these questions earlier. Yes, BOJ will definitely intervene when the exchange rate is going to impact their GDP growth. So whether is a good strategy in an open market, in an ideal world, I would say no. But since we highly likely the is a good idea is actually to intervene, I would say, because it can literally stop a lot of traders from taking advantage of the situation.
Yeah.
And also one thing that's kind of against the intervention is that Japan like literally holds lots of U.S. Treasury bills, which is the U.S. debts, right? So if Japanese yens becomes cheaper and cheaper, it's actually easier for the Japan's government to finance all their the budgets from a US dollars perspective. So that is one pros for Japan's to benefit from cheaper yens.
Thank you very much for your insights today and your opinions.
You're welcome.
Well said, Mr. Lee. Now, in order to delve deeper and understand why the Japanese yen is depreciating, we also have to look at the historical context in order to understand. In 1950 to 1990, it was the booming ages of economic growth in Japan. However, in 1990 to 1999, real estate and stock prices was too high until the bubble bursted, which is when they went into depression. After they recovered, their inflation rates has all been close to zero until recent years. They recovered really slowly, essentially because the large households are taking out too much debt when the asset prices are rising. So when the asset prices fall, the households are more focused on paying off their debts instead of spending to decrease their chance of bankruptcy. This progressed to a point causing deflation. People are more focused on paying off their debt and mortgage instead of spending, and they realize that their money are actually more valuable as the days goes on. So people will continue to wait and decide not to spend, which causes a really bad cycle, which stagnates the economy. So the BOJ decreased interest rate to a point which is basically negative, where people will lose money if they put their money in the bank. And they will have very, very cheap loans to incentivize spending. However, Japan has a very aged population with low birth rate, and also they're paying back debt, as we mentioned before. So therefore, the cheaper borrowing rates and negative interest rate didn't quite work because no one wants to borrow money anyways. Japan needed another way to keep the economy moving and prices up, so they decided to use quantitative easing, which is basically central bank injecting large amounts of capital into the economy so that the banks and financial institutes can hand them out to consumers and businesses as loans to stimulate economic growth. This is a proved method by a lot of Western countries, and they have used it since 2008. And it worked quite well. Indeed, the inflation has increased and peaked at 4%, which the Japanese government decided to make the interest rates positive again. However, no one has done it as much as Japan. Since it is injecting money into the economy, Japan's national debt surpassed 254% of its GDP, and recently it has been falling back down again. Since its national debt is so high already, they do not have much stuff to do rather than just moving back the interest rate to negative again. But as we've seen before, it has been proven not to be quite useful in the long run.
So now, coming back to the problem that just happened a few days ago, we can see that the decreasing value of yen is inevitable. And the intervention of the Japanese government, i.e. using like 35 to 39 billions of dollars of foreign reserve to buy yen, is not a good solution. It did not solve any long-term problems, nor the fundamental problems consisting within Japan. As you saw in the graph, the value appreciated for a amount of hours that it became higher again. Buying yen does not fix the fundamental problem of Japan, and all it does is increase the demand for yen, the artificial demand for yen, in a short period of time. And in the long term, the market will set the value all over again.
And that is all for Big Richard's Newscast.
Now we'll go on to Big Richard's Banquet ASMR and then to the weather news report from Daphne. Alright, welcome to Big Richard's mukbang. So today we have what do we have here? Oh, we have takoyaki. So for takoyaki today, we have a side of fresh takoyaki sauce, which is sweet and savory kind of. So shall we? So we did this. Okay, so takoyaki is basically deep fried flour, and there's octopus, a little bit of octopus inside. It's our Japanese type of food, so we're gonna have a bite.